You're staring at the chart, waiting for confirmation. Smart money already bought. The reason you missed it isn't because you weren't watching. It's because they didn't want you to see. Today I'm breaking down the Iceberg Order Pattern, how institutions hide $100 million trades from retail, and the 3 signatures you can spot if you know where to look. There's a phrase you hear constantly in trading content: follow smart money. It sounds smart, it sounds like an edge, but it misses the most important thing about how institutions actually operate. Smart money does not want to be followed. Their entire job is to hide their footprint. If a hedge fund wants to accumulate 500,000 shares of a stock and they let you see that order, 3 things happen immediately. Retail front runs them. High-frequency algorithms pile on. The price moves 20% against them before they've filled half their position. And their thesis, the same thesis they spent 3 weeks of research building, just got eaten by the visibility of their own order. So they don't show you. They use iceberg orders. The metaphor is exactly what it sounds like. The tip of the iceberg is visible above the water. The mass, 90% of it, is hidden below. An iceberg order works the same way. A hedge fund wants to buy 500,000 shares. Instead of placing one big visible order, they program the exchange to show only 1,000 shares at a time. When that 1,000 gets filled, the system automatically refreshes another 1,000 at the same price. Then another, 500 times. To anyone watching the order book, it looks like a steady stream of small 1,000-share buyers. Nothing special, no alarm bells. To the algorithm doing it, it's a controlled accumulation of 500,000 shares with minimal price impact. The price barely moves. Retail sees nothing. The position gets built. This happens every single trading day in every major market: equities, futures, forex, crypto. The mechanics change slightly. The intention is identical. You cannot see the iceberg directly, by design, but you can see its footprints. There are 3. Signature 1. Repeated identical print sizes at the same price. Open your time in sales. If you see 1,000 shares print at $20.10, then another 1,000 at the same price, then another and another for 15 straight prints, that is not coincidence. Random order flow doesn't cluster like that. An iceberg refresh does. The same logic applies to futures contracts. The same logic applies to forex pairs at round number price levels. Whenever you see size repeating exactly at the same level, an algorithm is feeding it. Signature 2. A persistent bid or offer that won't fill. You watch a stock approach a key level. There's a 50,000 share offer at the round number, let's say $50. Buyers come in, eat through 10,000. The offer refreshes back to 50,000. Buyers eat through 20,000. Refreshes again to 50,000. That's not a single trader sitting there with a 50,000 share order. That's an iceberg with a much larger hidden block being distributed slowly. Every time the visible portion gets eaten, the algorithm refreshes it. If you're long that stock, you are now trading directly into institutional supply. Every share you bought, an institution sold to you. Signature 3. Volume up, price flat. This is the cleanest tell. Pull up a 15-minute chart. Look for periods where volume spikes significantly above average and price barely moves. Either it goes sideways in a tight range, or it grinds in one direction with no real follow-through. That is accumulation or distribution in progress. Real conviction moves price. The fact that price isn't moving despite the volume means someone with size is absorbing every share that gets sold to them, or unloading every share into demand. Either way, a position is being built quietly. Once you can see these signatures, your trading changes in a specific way. You stop trying to be early, you start trying to be right. If you see persistent accumulation signatures, repeated print sizes on the bid, persistent bids that won't get hit through, volume up with price flat near support, institutions are buying. Your job is not to figure out exactly when they finish. Your job is to be on the same side, with a stop loss that accepts you'll be wrong sometimes. The opposite holds for distribution. Repeated offer sizes that refresh. Volume up at resistance with price unable to break. Sellers eating every bid. That's not a healthy market trying to go higher. That's an institution unloading into retail enthusiasm. The single biggest mistake retail traders make at distribution tops. They buy because volume is high. They mistake volume for conviction. Volume in a flat or capped range is usually the opposite of conviction. It's a transfer of inventory, from institutional hands to retail hands. And then the institution stops absorbing, and price falls because there's no one left to support it. The buyers who provided the volume are now holding the supply the institution just gave them. If you have ever found yourself stuck in a position that had so much volume going in, you were the volume. Every market you trade is actually 2 games happening at the same time. The visible game is the one you see on your screen. Price moves, candles form, indicators flash signals. This is the surface. The invisible game is the one institutions are playing. Position building over days and weeks, inventory transfers, liquidity hunts. This is what actually drives price over any time frame longer than the next 20 minutes. If you only trade the visible game, you will get chopped up by the invisible one, because the visible game is the noise the invisible game uses to do its work. The signatures I just walked you through are how you start to see the second game. Not perfectly, not every time, but often enough that you stop being the retail trader who keeps buying the breakout right at the top or selling support right at the bottom. Those breakouts and breakdowns are usually the institution finishing what they started weeks ago, and you're providing the exit liquidity. The iceberg pattern is one specific institutional footprint. There are more: order block formations, liquidity sweeps, fair value gaps. I'll cover those in the coming Sundays. But before any of that matters, you have to fix the reason you ignored these signatures even when they were obvious. That's a psychology problem, not a chart problem. Tuesday, I'm publishing a short on confirmation bias, why your brain will tell you the iceberg signatures aren't there even when you're staring at them. If you want to stop missing these patterns, that's the first piece. Subscribe so you don't miss it, hit the bell, and drop a comment with the ticker or pair where you've personally caught an iceberg signature. I'll feature the best ones in next Sunday's video. This is Market Pulse Studio. See you Tuesday. As always, this is educational content, not financial advice. Trade your own analysis.